Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
In today's video, we're going to talk about the journey of an SIP investor. An SIP investor is someone who believes in having a disciplined approach to savings, who is able to consistently save month on month, and who's not too worried about market volatility. Yet, when we look at the journey of an SIP investor, an SIP portfolio at some point becomes a lump sum portfolio. The SIP investor is also worried about what is going on, whether they are in the right fund, whether they're making the right level of returns, what they should do when the returns are not looking good. So these are all questions that will come into a SIP investor's mind as they progress in their investment journey. So let's take a look at what is happening with most SIP investors. Now, one thing that is concerning, and this is data that has come in from AMFI, is that the SIP stoppage has actually gone up. Now, SIP stop shows us that investors are either no longer continuing their SIPs, that is, they've started something, they've left it halfway, or they have planned to do their SIPs for a certain number of months and they have not renewed it beyond that. When an investor starts an SIP, they usually have it aligned with a particular goal or a timeline in mind. Now, 1 year as an SIP investor is really not going to give you that much in terms of benefits. The real benefits start coming in when you've spent a few years as an SIP investor. Because after all, each unit is invested in 1 month and then that investment becomes long term only 1 year later. Whatever timeline we may have in our mind, the market context may change quite a bit, which might require us to change our strategies. Typically, SIPs are insulated from this if we pick the right funds. In certain categories, the fund itself has a lot of flexibility and can adapt to the changing market context. But if we are investors in the SIP route, say in a thematic or a sectoral fund, the sector or theme may run out of flavor and fashion and an investor actually has to change their SIP at that point. Whereas if someone was choosing something like a multi-cap or a flexi-cap fund, it's very possible for the fund manager itself to adjust and respond to how the market is doing at this point. So when we look at SIPs, we need to recognize that one, the fund actually matters. Where we are doing the SIP actually determines how long we can continue to run that SIP. The second important thing that we need to know as SIP investors is that at some point our SIP portfolios become lump sum portfolios, which means we need to treat them as such. A lump sum portfolio tends to carry more risk and can have larger drawdowns because it's a larger portfolio in size. So over time we need to also pay attention to whether SIPs need profit booking or not. The third thing that we need to look at is how to scale up our SIPs. We have certain funds that we do. Every year as our income grows, we should also be increasing our SIPs to a certain extent. Now, an investor can choose to diversify their SIPs into a different asset class. They might also decide to do it in fixed income or a low volatility asset class and then use that additional income as lump sums in their portfolios. So there are many ways in which an investor can actually manage their SIP, and there are many experiences that an investor will have through this journey of being a SIP investor. What are your experiences? Let us know in the comments below.